Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Welcome to today's Savant Live webinar, and thank you for joining us. Today we are discussing tax changes looming. Plan ahead for the TCJA sunset, the Tax Cuts and Jobs Act. My name is Chris Plague, and I am the tax growth leader here at Savant, and I'm pleased to be joined by Mike Mesh, who is one of our tax team leaders based in our Cedar Rapids, Iowa office. All right, so here's our agenda for today's presentation. We're going to start off by giving you some insight on what the sunset provisions are all about, followed by a discussion on some of the specific changes that will be impacting individual taxpayers. Mike will then discuss changes affecting businesses, as well as some pre-sunset tax planning strategies. We'll then wrap things up by discussing traditional tax planning strategies, as well as heighten your awareness about some other important new requirements for business entities, something called beneficial ownership reporting. So if you own a corporation or an LLC, you're not going to want to miss this part. All right, unless Congress acts soon, and that's not likely with its being an election year, most Americans are going to see higher taxes and more complicated tax returns beginning in 2026 because of the sunset of the TCJA. Now, dozens of changes are coming, and we will highlight some of the most important changes that you'll need to be aware of. All right, so the Trump tax law, or the Tax Cuts and Jobs Act of 2017, included major changes to the tax code and was passed under a process known as reconciliation. Now, that's an easier route to passing a tax bill, but it does come with some strings attached, some restrictions. And like I mentioned earlier, even though Congress could act to extend some or all of these provisions, they're all set to expire at the end of 2025. Now, Senator Robert Byrd from West Virginia, back in the early 80s, introduced legislation, and we now refer to it as the Byrd Rule, that says reconciliation legislation must be budget related and cannot increase deficits beyond a 10-year budget window. Now, basically, the authors of the TCJA, they knew that the law wasn't going to comply with the Byrd Rule from the start. So they built in these sunset provisions in order to keep costs down and to meet the Byrd Rule requirements. So what we want to emphasize here is that there's this short window of opportunity with everything sunsetting at the end of 25. We have, again, a short window to maximize our tax savings opportunities and implement strategies to do that. All right, so let's jump into some of the changes we can likely expect as a result of TCJA's sunset, starting with individual income tax provisions. And I wanted to call this slide Groundhog Day. So it reminds me, this whole sunset thing reminds me of the Bill Murray classic, the movie in the early 90s, where he's a weatherman who's caught in a time loop. And every morning he wakes up to relive the same day. Well, that's kind of what this sunset thing is all about. So individual tax rates are going to go back up, and individual tax brackets are going to compress back down. So an example of that, and we'll show a slide with more details here in a minute, we're currently in a top marginal bracket of 37% for individuals. That's going to go back to 39.6 in a year and a half. Likewise, the standard deduction will get cut in half. So right now, approximately 90% of taxpayers are using the standard deduction as opposed to itemizing. We're gonna hit the reset button here and go back. So one of those deductions that we'll be able to take again is unlimited state and local taxes. So right now, there is a $10,000 cap on SALT, state and local taxes. That's going to go away. We're hitting reset on that as well. So that's good news on one level, but the bad news is the alternative minimum tax comes back into play as well for millions of taxpayers. So the AMT is a calculation that involves what are called tax preference items, things that lower our overall rate of tax, things like long-term capital gains rates, itemized deductions, exemptions, and so forth. So once we hit reset and we go back to itemizing, we're reintroducing the AMT again. Miscellaneous itemized deductions are coming back. Remember those? Remember the days we could deduct tax prep fees, safe deposit boxes, investment expenses, unreimbursed employee business expenses. All of those deductions are coming back in a year and a half. And likewise, mortgage interest deductions. We are able to raise the limit on deductible mortgage interest from the current $750,000 of mortgage debt up to $1 million. And then probably equally as, or even more importantly, is home equity debt. So right now on 100 grand worth of home equity debt, we can only deduct the interest if the debt is used to improve a primary residence. We're going back to the days now where we can use home equity debt for anything. So if you're drawing on a home equity line to pay for a vacation, pay off credit cards, whatever the case may be, buy a car, all of that interest would become fully deductible again when we go back. So here is this slide I mentioned regarding tax brackets. So I want to first focus your attention on the left side of the screen, where we see the top rate is 37%. And on the right side of the screen, this is what we're going back to. Again, we're hitting this reset button. We're going back to pre-Tax Cuts and Jobs Act as inflated for, adjusted for inflation rather. I just want to point out a couple of issues or important highlights here. So let's focus on the 24% bracket over here on the left side. So that's what we're currently working under right now. Look how big that bracket is, first of all, that burgundy color bracket. So the 24% bracket currently starts at about 200,000 of taxable income on a joint return and goes all the way up to $400,000. Well, when we hit reset and we go back to the way it used to be, first of all, you'll notice there is no 24% bracket over here on the right side. The closest we have is a 25% bracket. But look at where that bracket starts, right about $150,000. And that 25% bracket ends at about 230. Very, very small bracket. And then you jump up into a 28% bracket. Well, you know, the 24% bracket right now doesn't even start until about 200,000. So you get this is that compression I was talking about. Not only are the rates going up, but the brackets are compressing down. You'll climb into those brackets much faster. And therefore, we want to take every opportunity we can over the next year and a half to fill these lower brackets as much as possible with strategies that we can deploy. Okay, the other point I wanted to make here on this slide is these top brackets. So look at 37% under current law. You don't climb into that 37% bracket on a joint return until taxable income is over 700,000, about 731,000. Well, look what happens in 2026. Not only does the top rate go up, but we climb into that bracket at about 570,000 of income. So again, getting into these higher brackets, higher rates much faster. So we want to look for planning opportunities to maximize our tax efficiency here in the next year and a half. All right, so that kind of touches upon some of the important individual changes that are upon us. Now Mike's going to talk about some key sunset related business tax changes, as well as some pre-sunset planning ideas.
Thanks, Chris. Yeah, so I think it's time that we get into what can we do today to take advantage of the law as they stand, and what are some good decisions. It's going to be different for everybody depending on the situation that you're in. So of course, we always advise everyone to talk with their tax advisor and their financial planner, but these are some things that everyone should consider, and we wanted to make sure you're aware of them. First and foremost, business tax provisions. Two that we're going to touch on is the QBI deduction, which goes away after 2025, and the bonus depreciation, which will no longer be available after 2026. The QBI deduction is applicable if you own a business that is a pass-through business, meaning an S corporation or a partnership, some trusts, Or if you have a Schedule C on your personal tax return that you report income and expenses, perhaps as a sole proprietor. And how it works, it's really pretty easy in how it operates, in that the net income of that business generally flows through to your personal tax return, and you're taxed on the net income, right? All of your revenue less all of your expenses. With this QBI deduction, you take that net number, your net profit, and you can take 20% off of that before you're taxed. And of course, it's a little more detailed than that, the calculation, and your ability to take the deduction goes away at some point, depending on how much money you make. But the majority of people that I know are able to take this deduction. And it's a big tax deduction that people have been able to take advantage of over the last 6-7 years.
Right, and that's 20%, Mike, right, of whatever that flow through profit is. So one of the advantages that flow through entities received under the Tax Cuts and Jobs Act was this new QBI deduction, which was substantial.
That's right. And at the same time, if you're a C corporation, you received a lower tax rate, right? It's the 21% rate instead of the higher 35% rates that we had previously had. So this is the way that the IRS tried to make it so that other folks with flow-through entities could also get a tax deduction. So what does that mean for a QBI deduction going away? It means that we might look at some strategies to increase income in 2024 and 2025 to take advantage of this deduction, which you wouldn't otherwise have in 2026 and going forward. So we'll talk a little bit about that. Bonus depreciation also going away after 2026. You may have noticed on your tax return that if you took bonus depreciation, which really is just depreciation is you buy an asset, you get to write it off over time, right? Well, certain assets you can write off immediately using what's called Section 179 depreciation expense. If you cannot get rid of all of the cost of that asset, because that 179 has limits, you can take and choose to take bonus depreciation. So it really is just writing off a percentage in that first year of the cost of the asset. And as I started to mention, you may have noticed over the last few years that the bonus depreciation amount that you can take has decreased over time. In 2023, you could write off 80% of the cost of the asset immediately. 2024, it's 60%, and it keeps going down by 20% each year. And then we'll get to 2027 when it's 0. So it goes away unless Congress acts to extend this law. So we're going to go over some individual things we can do as well for income tax planning over the next year and a half. Roth conversions. So as we mentioned, there may be reasons to increase income over the next year and a half because of, Chris previously mentioned that the tax brackets are better for us through 2025. The tax rates are better as well. And so we may decide to fill up some of those tax brackets by either taking less depreciation through your business today, or looking for other ways to perhaps create income today at a lower rate than what you might incur down the road, and also do some estate, retirement and estate planning as well along the way.
And that's kind of counterintuitive, isn't it, Mike? The idea of like recognizing income if you have that opportunity.
Exactly. It's definitely something that takes a few conversations when you have this with someone to help them understand why we're paying more tax today. So Roth conversion is something that you can do to increase your taxable income today. And you might decide, depending on what tax bracket you're in, if you're in a retirement situation, it could make sense to fill up from a 12%, fill up the next, rest of your 12% bracket, or if you're in the lower part of the 24% bracket, we could fill some of that up as well. So you want to talk with your individual tax accountant about that. But Doing a Roth conversion is simply taking some money that you have in a taxable IRA account and converting it to a Roth. There's no income limitations, so you can do this whether you make 50,000 a year or 200,000 or $1 million a year. We can do this Roth conversion, and it allows for future tax-free growth on anything that's inside of that Roth account that you've converted. So we pay some tax today, and we do it thoughtfully, right, by filling up some brackets, and then we look at what you're going to pay ultimately when you take that Roth money out later, as if you had kept it in a regular IRA. Compare that to we're going to pay no tax, and we'll prove up to you the benefit of this Roth conversion. One of the things we do for tax planning as well as retirement planning is we look at not only today, what can we save you, but in retirement, if you were lucky enough to have enough money in retirement to look at different ways to access your money, then I think it's important that we consider the tax consequences of retirement. A lot of folks will just put their retirement contributions on cruise control, right? And they'll max out a regular 401k every year, and they build up a nice nest egg, and then they get to retirement and they maybe finally meet with a tax or a financial advisor, and they get some bad news that we're going to have quite a bit of taxable income with required minimum distributions out of your retirement account. In addition to that, that taxable income will also make more of your Social Security tax or income taxable. And it could also increase the cost of your Medicare costs as well. So with a little thoughtful planning, we could take some of that taxable retirement income and convert it to non-taxable and perhaps save a lot of money in retirement. All right. The other thing we want to make sure you're aware of is just the ability to maximize your 401k. For 2024, you have the ability to, if you're under 50, to put $23,000 into your 401k. If you're over 50, they allow for a catch-up for those who may need to catch up and put additional money in to fund their retirement, and that's an additional $7,500 for a total of $30,500. And we always tell people, at least consider taking advantage of your 401k match from your employer. That's free money every year. It's important to, I guess, look at all aspects of your employment compensation and make sure we're taking advantage of that. Something else to consider, a lot of 401ks will have an option to do a Roth 401k contribution. So it'd be good to check with your employer to see if that is an option, and then work with your financial advisor and tax accountant to see if it makes sense for you to contribute to that Roth 401k. And the difference really being is that the growth inside of your Roth 401k grows tax-free. Your contribution is non-deductible in the year that you make it, but it allows, that option allows you to have some tax-free money in your retirement as well.
And that's really an option, getting back to, sunset and this idea of taking advantage of the next year and a half with these lower tax rates and expanded tax brackets, where you could maybe flip the switch on your deferrals and go to Roth, where again, we're paying a little more tax on income as a result of that, but it's hopefully at lower rates.
Yeah, and I know some people who, we might flip the switch every other year, as to what we should do, contribute to the Roth 401k or the deductible, depending on, if they're business owners and their income goes up or down in a significant year. All right, something else that we could take advantage of is if you're charitable. You may have noticed on your tax return the last few years that you're not getting a deduction or as big of a deduction as you had in the past. And that's part of going back to what Chris mentioned earlier. The standard deduction Most of the country takes advantage of the standard deduction, which in 2024 is a little over $29,000 for a married filing joint couple. So essentially, you have to get over $29,000 worth of deductible medical costs, the $10,000 cap on the state and local taxes, mortgage interest, and charity contributions before you can get an advantage of additional charitable contributions. So a lot of folks will come to us and say, I'd like to give to charity. Is there a way I can do it more tax efficiently? And so we talk about a couple different strategies. The first one is called bunching your donations. And it's as easy as it sounds. If you normally give $5,000 to charity every year, and you give it on a monthly basis, you might decide instead to give $10,000 every other year. And people often get worried, with their church or whoever they might be giving the money to, boy, they rely on my monthly donation. And so, I suggest people, have that conversation. If you've got a close relationship with a charity that you support every year, have the conversation and say, this is what I would like to do. Give them a heads up. And we can, certainly work with them in various capacities to try to, deal with that cash flow issue. But the easy thing to do is, this is the easiest path, I should say, to increasing your donations and making sure we get a tax deduction. If you want to supersize your tax benefit, we can do what's called a donor advised fund. I know several people who have done this in the last 2, 3, 4 years and gotten a big tax benefit from it. So essentially, a donor advised fund is something that you can set up with Savant. It's a separate account that is available for you to move money into that account. And then that money is set aside for future charitable donations. So if you have an account with Savant or another financial advisor, you can simply set up this account, move money over. And if you move over $10,000, $20,000, you're going to get a tax deduction for the amount you move over in the year that you move it. Then that issue that I mentioned on the last slide, where your charitable organization that you normally give to may depend on a regular contribution from you. You can take that $20,000 that you moved over into your donor advised fund and dribble out that money over time. So if you normally give $100 every month or $200 every month, you can set it up such that that money is donated on a monthly basis to these charities. So it's a great way to overcome, that potential issue, as well as get a tax deduction in 1 year and really be tax efficient. On top of that, if you have investments that are that have accreted in value, right? We've got a lot of capital gain inside of your investment account. You can move those investments, so those stocks, over to a donor advised fund without selling them. And therefore you avoid paying the tax on those investments. And so normally what you'd have to do, if you think about it, is I've got $20,000 inside of my taxable investment account, of which I've contributed $5,000, 15 years ago. It's grown to $20,000. I would have $15,000 of built-in gain on that to pay tax on if I were to sell that money and then, sell those assets and then give the money to charity. Instead of doing that, you can give the whole $20,000 to the charity inside of the DAF account. The DAF will sell the stock and realize no capital gains and give that cash over to the charity. So it's a real way to supersize your gift and take advantage of this unique strategy. When might you do these things? I have some friends who have taken and set up donor advised funds in years where they have very large one-time events, right? Taxable events. They could be some big distributions from a 401k or a big business event or a business sale, that sort of thing. So that's something that you want to talk with your tax advisor about and your financial advisor to see when it makes sense. So if you own a business and you try to maximize your QBI deductions for 24 and 2025, things we talked about previously is accelerating income. Ways to do that is putting fixed assets that you're acquiring. Maybe we don't take a 179 or a bonus depreciation this year and instead depreciate it over 5 or 7 years. We could defer expenses as well. So if you do need to buy equipment, we could buy those in 2026 instead and go back and take section 179 or bonus that year because it's still available for one more year, that final 20% in 2026. The important thing with all of this is finding the sweet spot. And that's why I think it's important to work with an advisor who knows your situation and can help you do the calculations to determine what's best.
Okay, well, I'm going to pick it up from here. And the next few slides we're going to look at here aren't necessarily related to sunsetting a TCJA, but they do include some important strategies that we think are very, very important to consider every year. And the first is tax loss harvesting. So again, kind of like how Mike was talking about, it's a little counterintuitive sometimes to want to accelerate income, but this window of opportunity exists with the sunset situation. It's also sometimes not intuitive to think about selling positions in your portfolio at a loss on purpose, but doing so allows us to offset capital gains. And so one of the things that we talk about a lot is tax efficiency. And it's not how much money you earn or how much you've accumulated in your lifetime, but how much do you really get to keep? And tax efficiency is at the root of that. So recognizing losses on purpose and harvesting losses out of your portfolio is a way to offset realized gains in the current year. And sometimes you want to recognize a little more losses than you may know you have in realized gains, because gains are at oftentimes hard to predict. And an example of that is long-term capital gains coming out of a mutual fund. So those typically aren't known to us, to investors and to tax professionals until after the fact or very, very late in the year. So if you harvest some losses and build up a bank of losses, you wipe out all your gains. Once you've wiped out your gains, you can take an additional $3,000 deduction against other ordinary income. And then better yet, you can bank any unused losses for use in the future. So that's just a nice way to proactively offset realized gains. Now, we do want to point out something called the wash sale rule here, because many times when you're thinking about selling for purposes of loss harvesting, there might be positions in your portfolio that you believe are going to grow and reverse course in the future, and you want to stay in those positions. Well, you can always harvest the loss out as long as you wait at least 30 days before repurchasing what's called a substantially similar investment. You will then avoid the wash sale rule, which is a disallowance of that loss. Now, custodians will generally report wash sales that occur within their accounts. But what happens if you have multiple custodians? What if you have accounts at Schwab and Fidelity and Vanguard, and maybe you're selling positions in one of those accounts, but then repurchasing in another? You just need to be aware that these wash sale rules exist, and technically you should be disallowing the loss, even if it's done with a repurchase in another custodial account. So the other thing that I wanted to highlight here was there's actually brackets, tax brackets for capital gains rates. So we're all familiar with the fact that if we sell an investment or an asset at a gain, there is a capital gains tax. It's a preferred rate of tax. So remember when I was talking about alternative minimum tax earlier coming back into the picture in 2026, this is one of the reasons why AMT kind of rears its ugly head. But what a lot of people don't realize is that there's actually a 0% long-term capital gain rate. So if you look, for instance, at taxable incomes, I have a line for single, married filing separate, or joint here. Let's just talk about the joint line. If your taxable income, so again, that's gross income minus either the standard deduction or itemized deductions. If you wind up at taxable income of $94,050 or below, the capital gains rate is 0. So if you had any realized gains in that year, you'd pay 0 tax on those capital gains. What we see happen often is we don't, again, we talk about filling buckets a lot here too. So might there be opportunities to kind of the reverse of harvesting losses like we talked about a minute ago to offset gains? What about harvesting gains if you've got opportunities to fill that 0% bucket and avoid tax altogether on a capital gain? The next bracket is the 15% bracket for capital gains, and that's huge. I mean, look at this, 94,051 all the way up to almost 584,000. So that's a big, big bracket at that 15% capital gain rate. You don't climb into that top 20% until 584. So the point here is just having this bracket awareness, we call it, whether it be capital gains or even the ordinary tax brackets that we were referring to earlier. Make sure you have an awareness around those and make the best use of them from a planning standpoint throughout the year. And again, I think it's emphasized with the sunset of TCJA here, changing those brackets and rates in a year and a half. Now, we really don't have time to delve too deeply into estate tax issues in this presentation, but I do want to mention that one of the other provisions that's sunsetting in a year and a half is the unified exemption from the estate and gift tax. So right now, that's about just under $14 million per person. So if you pass away with an estate below that 14 million-ish number, there's no estate tax, but that's one of the issues or provisions that are rolling back. We're hitting the reset button and we're going down to 7 million approximately per person. So the whole point here is just consider timing with all of this. And one of the most powerful tax savings opportunities we have under current tax law is something called step up in basis. So as you may know, if you sell a position that's in a gain situation while you're living, that's a realized capital gain that's subject to income tax. But if you were to hold that position until after death and then pass the asset to your heirs, there's a step up in basis. So you effectively eliminate that capital gain from your beneficiaries if they were to sell it shortly after you pass away. So it's powerful, right? But you're kind of rolling the dice a little bit here, particularly with the sunset of that exclusion from 14 million down to 7. So maybe dust off your estate plan, think of things like portability of your exemption, but have a rock solid financial plan in order to minimize your exposure to not only income tax, in this case, capital gains, but estate tax if you do have these highly appreciated assets. Another thing we'd like to talk about is inherited IRAs. So there's some new info here. But back in 2019, the Secure Act came out and changed the rules when it came to inherited IRAs. And the new rules were that if you were a non-spouse beneficiary of an IRA or a 401k, that non-spouse beneficiary had to take all of that money out of that account within 10 years. Now, again, this only applies to situations where the account owner dies after 2019. And prior to this new rule, we could use what's called a stretch IRA. Regardless of whether it's a spousal beneficiary or a non-spouse, the beneficiary could stretch that out over their own lifetime. Well, that's gone now for non-spouse beneficiaries. But what this new law didn't make very clear was whether those beneficiaries had to take money out each year, or if they could wait until the final year to take that money out. So there's a lot of debate and a lot of heartburn over what do we do? And what ended up happening was a lot of people ended up skipping RMDs or distributions in the early years. Well, we just got some clarity on this. Believe it or not, it took 5 years for the IRS to finally issue final regulations just this past month that clarified the fact that yes, non-spouse beneficiaries must take yearly RMDs beginning in 2025 based on the beneficiary's life expectancy. And again, as I mentioned, a lot of people weren't doing that. So the IRS also said, well, we're going to waive the penalties for missed RMDs in those early years. So 21, 22, 23, even though technically under the Secure Act, you were supposed to take RMDs, we're not going to assess a penalty if you did not. Now, the regs also confirmed that the 10-year rule still exists. So if you do start taking RMDs in 2024 or in 2025, after having skipped several years, the account still must be fully withdrawn. It must be empty, again, for non-spouse beneficiaries at the end of that 10th year. And so that's this tax balloon that we're referring to on this slide. So depending upon what the RMD is, depending upon what the size of the account is, if you do the bare minimum over the next few years, you could run into a situation where you have a large distribution in year 10. Depending upon the tax environment, both personally and under whatever the tax law is at that point, it could be a much higher tax outcome, not very efficient if you wait. So consider taking more than just the RMD out every year. And again, fill those lower brackets. So that's kind of the theme of pre-sunset strategy here. Let's take opportunities to have what is pre-tax money taxed at the lowest possible rates that we can. Another little tidbit here is, do you own a business? So if you do happen to own a business, we often see situations where taxpayers aren't employing their kids. Now you have to be reasonable with this. They have to do legitimate jobs and be paid a reasonable wage, but the kids are going to be in lower tax brackets and rates than the parents. But it also gives them earned income and the ability to do Roth contributions every year. So it's a nice way to kind of kickstart retirement savings for the kids and transfer some income to lower tax rates during the year. We also see many times missed opportunities on home office deductions. So again, we're not going to have unreimbursed employee business expenses come back for another year and a half. But if you have a Schedule C business and you run that business out of your home, look to one of two avenues for capturing a home office deduction if you're not already doing that. And then maximize retirement plan contributions. So again, Mike talked about finding this sweet spot between QBI and the retirement plan deduction, which lowers profits, but go through the math. It's worth the time and the effort to try and figure out where that sweet spot is. All right, and Mike talked about this a little bit too with the DAF scenario. So whether you use a DAF or not, you can also donate appreciated assets or securities directly to the charity. So I'm not going to go through all of this math, but we have two scenarios here. Let's say you have an appreciated stock worth 50 grand and the basis is only 5. So this gain that's built into that stock is 45,000. Well, option one is you sell it, you pay tax on the gain, then you donate the remaining cash to the charity. Well, that's not very efficient, not very effective. And when you do it that way, your tax savings is only about $3,600, $3,630. So why not go to option two and donate the security itself directly to the charity? You get the full value, that fair market value of 50,000 as your deduction. And if you're in a 24% bracket, you save 12,000 bucks. Much more effective, much more tax efficient to donate those appreciated assets if that's the only source you have for making the donation. And also in that same vein, qualified charitable distributions. So just like donating appreciated assets, it's much more powerful and tax efficient if you're charitably inclined to use a QCD. So what is that? That's where you take a distribution from your IRA, if it's your RMD, and you could actually do it at an earlier age, 70 and a half. And you, instead of taking that distribution and paying tax on it to then make a donation, you just donate straight to the charity. The math is the same as what we saw with donating appreciated assets. You get the full value of not reporting that income versus giving up the tax deduction for the charity. But if, again, you're getting the standard deduction anyway, why not do it this way? So the math works better to do a QCD if you're so inclined, and you don't need to put any money in your pocket. Now, the one important thing to do if you are going to use a QCD as part of your strategy is make sure to tell your tax professional about this. Because when that 1099-R shows up at the end of the year in January, where it's tax time and we're getting all of our tax documents ready to go, that 1099-R is not going to have a designation on there that it was a QCD or that it went directly to charity. So let your tax professional know that that's what was done. All right, so now we're going to jump into this thing called beneficial ownership reporting.
Thanks, Chris. Yeah, so this BOI reports or beneficial ownership reporting is a bit of a hot topic for 2024. It's new this year. And essentially it was set up as a reporting mechanism by the FinCEN or Financial Crimes Enforcement Network, part of the government. So it's not an IRS entity. It's the same entity that if you have any foreign reporting or foreign bank accounts where we've got to submit a FinCEN report each year with your tax return and report the value of those accounts. So the government's just trying to get some more information as to who owns entities within the United States. And so that's what this is about. It's new in 2024. There's some different rules because it's a first year. So because it is a first year, if your entity was set up, and this includes single member LLCs, by the way. So if your entity was in place during 2023 or before, then we have until the end of the year, essentially, to get this BOI report completed. If it's new in 2024, a new entity was created, then we have 90 days from the date of creation of that entity to file this report. And then starting next year, any new entities are going to have 30 days to report. So the government, or I should say FinCEN specifically, is really trying to make sure everyone knows that this is not suggested. It is a required report that needs to be done. No tax due or anything like that. And really no real financial information report other than there are some specific rules, which we won't get into today, as to some folks don't have to file this, but I would just go under the assumption that you do need to file this. Check with your advisor and they can help. And in fact, we recommend that you check with an attorney if you have an attorney that you consult with on matters. They should be up to speed on exactly what needs to be done to get this filed. Also give you a little information on that though. So as I mentioned, it's not optional. One of the ways they try to make it not optional is by giving you a pretty hefty penalty if you do not file on time. The penalty is $500 per day, up to $10,000. And they mention up to 2 years in prison. The reality of this is, though, they're looking for people, right, who maybe are not reporting the ultimate owners of businesses, and they're looking for folks like criminals who are not reporting cash flow and they're funding terrorist organizations and things like that. So they're just trying to gather more information as to who own businesses. And the reality is it's a report that you file. It takes what, Chris? I think it took 15 minutes. I did one for my brother the other day.
Yeah, it's really pretty easy to do. So this is all new, and I'm suspecting that many of you on this presentation may not have heard about this. And so again, the whole point is just to increase awareness around this reporting requirement. So any entity that's been created at the state level, Secretary of State level, so corporations, LLCs, even single member LLCs, if you have a rental property that you've dropped down into an LLC, all of these entities are required to report. And it sounds scary, it sounds complicated. It's really not that bad. You can go to the FinCEN website and they walk you through the process. You can even download the form. You essentially fill out a form that identifies who the owners of the entity are, and you submit some form of identification, either a driver's license or a passport to go along with that. It's not that terrible to do, but to kind of frame this in terms of the scope, the Journal of Accountancy just came out with an article yesterday that indicated both FinCEN and Congress are really worried about the compliance aspect of this, that of the 32.6 million businesses that they estimate need to file a BOI form, only 2.7 million have thus far complied, even though the year is more than half over. So it doesn't take that long. It's not that difficult, but it is very, very important. The penalties are very, very harsh if you don't file these forms.
Yeah, so the important thing to know as you get started filing these is that you need to know the name, address, social security number of each owner of the business, and you need to upload something to prove that, right? So it may be a passport or a driver's license, state issued driver's license. So that's important information to get. And if you're a large corporation that has lots of owners, that may be a little bit time consuming. So that's something you can start working on. And then the website to read more has a lot of good information on it, videos about how to fill it out, and videos if you qualify for an exemption. That website is www.fincen, FINCEN.gov, gov-boi. So www.fincen.gov/boi. And I did it for the first time actually a few days ago for my brother's business, and like I said, it took me 15 minutes that first time because I watched a few of the videos to make sure that I caught every piece of it, but very quick and very easy. And let us know if you have any questions about that.
Yep, I've done it too. And again, you can always reach out to the attorney who organized your LLC or corporation for help as well.
All right. Well, I think we're just about on time here. It's about 1:50. Definitely click the link in the chat if you want to schedule a free 15-minute call to go over anything specific about your situation. I know we covered a lot of topics today. I think we do have time, Chris, for a couple quick questions. And there's our disclosures that we go over as well, or make sure everyone reads to understand some of the topics we covered today. You need to speak with your own advisor and make sure that you get your questions answered to your specific circumstance.
We do. And so again, thank you for being with us. So we do have a few minutes here, and we've been watching the Q&A box. We thank you for uploading your questions. So I'm going to take a stab at the first one here, that regarding the Secure Act non-spouse rule, do missed RMDs need to be made up in 24 or 25? So I did mention that there is no penalty for these missed RMDs, but there is no requirement to make them up. Okay, the only requirement is you must begin taking RMDs in 25. And again, getting back to by year 10, end of year 10, the entire account must be zero. So no requirement to make up the missed RMDs.
Thanks, Chris. I'll take one. Should I be contributing to my Roth IRA first or a 401k first? As I briefly mentioned during the presentation, everybody's circumstance is different. As a general rule, I like to think that we like to take advantage of any employer match first. So if you're Employer only offers a regular 401k, a deductible 401k option. Perhaps consider contributing up to the point where you get 100% of the match that's possible from your employer. And then any money in addition to that, we would look at, funding a Roth IRA account, whether it be a direct or an indirect Roth IRA.
Very good. I'll take another one here. Do the capital gains brackets and or rates sunset with the TCJA, or do they remain in the same as currently in force? So again, Congress can act legislatively to change anything, extend anything at this point, but even with the sunset happening in 2026, those rates that I mentioned, that 0, 15, and 20% rates, they don't change. The rates stay the same. What does change, though, is the entry points to those brackets. So it's based on where the, I think the 15% bracket starts at the bottom of the 25% marginal bracket once we get to 2026. So it's just, again, and I talked about bracket compression, where these brackets are compressing down and the rates are going up. You're just going to get into those higher capital gains rates too faster post January 1, 26.
Let's see here. If I'm considering contributing to a donor advised fund, how would you suggest I get started? That's a good question, because we're, in starting up the fourth quarter here in a month or two. And a lot of this planning gets done in Q4 for clients and for our friends. I would suggest, of course, meeting with your advisor, your financial advisor, your tax accountant, to decide, determine if it's important or, I guess, advantageous for you to set up a donor advised fund in 2024, or perhaps, there's an event happening in 2025 where it makes more sense. And then if you decide it's the year to do it, you can always set it up and not fund it, right? Or fund it with very little, just to get something set up. And I would suggest doing that sooner rather than later. As we get closer to the end of the year, of course, we get busier, not only the holidays, but everyone down the line of setting up a donor advised fund gets busier, right? If we're working with something through Fidelity on their back end, it takes a little bit more time. So I would suggest no later than November to connect with your advisor and get going on setting that up. It doesn't take a long time or a lot of paperwork, but better safe than sorry.
All right, I think we have another minute or two, so I'll take one more here. Will the taxation of home sales change if the current law expires, so after sunset? The short answer to that is no. If we're thinking of it within the context of the ability to exclude a portion of the gain on the sale of a primary residence. So right now, there is a $500,000 exclusion on the sale of a primary residence on a joint return, and it's $250,000 on a single. That won't change effectively post sunset. Now, again, Congress could come in and just turn everything on its ear, but there's no change happening there.
I can take one more question as well. I think we'll probably have to finish up after that. I previously was advised that if you don't have a good records of the basis of the security, donating appreciated securities was a way around it. But a friend recently donated appreciated securities and they were compelled to calculate the basis. What's the scoop? We do report the basis of appreciated securities on Form 8283, which is the donation form within your tax return. So what we do is if you don't have a good idea of what the basis is, we do our best to work with you to recreate a reasonable basis, based on a number of things. But we've certainly worked through something like that before with our friends, and it doesn't have to be a gargantuan task.
in the end, you're writing off the value of the security, right? So it's not so much needing to traditionally calculate that realized gain, but you do, as Mike points out, have to report a basis number on that form for a non-cash donation. All right, well, thank you all for joining us here today. We hope this was helpful. I know there was a lot of moving parts to all this, and we tried to cover a lot of material in a short period of time, but we appreciate your time. Thank you very much.
Thank you.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.